Hello, and welcome to the July market update from Commonwealth Financial Network. My name is Brad McMillan. I'm Commonwealth's Chief Investment Officer. We had a great month in June. Around the world, stock markets were up by between 6 and 7%, which is an extraordinary performance. That capped off a really strong quarter as well. Here in the U.S. and the developed markets, they were up about 3 to 4% for the quarter, while emerging markets had a tougher time, but even so, they finished in the black, up a little bit less than 1%. When you look at year to date, the U.S. is up somewhere between 15 and 21%. Developed markets are up about 14%, and even emerging markets, despite the turbulence, are up about 10%. This is a fantastic start to the year for stock markets, and in fact, even fixed income is making significant money. And the question we have to ask ourselves is, why is this happening, and is it likely to continue? Well, ironically, the reason this is happening, especially in the past month, is because everyone is so worried. Markets are worried about slower growth. Investors are worried about earnings. Everyone's worried about geopolitics. Everyone's worried about trade. And because of that, people are getting more nervous, and in fact, we're starting to see interest rates drop. The Fed was getting nervous too. In fact, the Fed came out with its statement this month, which was significantly more dovish than the markets expected. And all of a sudden, the market started to price in a rate decrease from the Fed, which pulled interest rates down further. We're seeing much easier policy, or at least that's what markets are expecting, and that gave markets a big push going forward. We're actually seeing a real tailwind for markets from monetary policy, whereas before it had been a headwind. And that's a big change. To get even more ironic, all of this worry, all of these lower rates are actually maybe not necessary, because we're seeing the actual data come in much stronger. We're seeing income and spending come in quite strongly. We're seeing retail sales bounce in a big way. We're seeing the housing market, which is a terrific indicator going forward, doing quite well, and in fact, it will probably do even better as interest rates drop. And at the end of the month, we actually saw the trade war, one of the major worries out there, put on hold. So in other words, for all the worry, for all the lower rates, things are actually pretty good. And as we start the second half of the year, we're actually looking from an investor perspective, it could be one of the best of all possible worlds. We're seeing easy monetary policy with lower rates, but we're also seeing slower growth. And we're seeing risks actually start to recede potentially. Given all that, it's small wonder that stocks did as well as they did in the first half of the year. Now, that's not to say we're out of the woods. Of course we have worries. The market's not really looking at the problems in Europe. Italy is an issue. Brexit is likely to be an issue. Here in the U.S., we certainly have the debt ceiling coming up, and that's going to be significant. On top of all that, we do see growth slowing, but slow growth is still growth. Slowing is still growing, and that's a good thing. And the bottom line is conditions remain solid. So as we move into July, things are actually pretty good, certainly better than they might have been. Will that hold? I don't know. We'll see next month. Thanks for watching.